finish this part so that this week we can do chapter 3, 4, 5, 6, a few chapters that require more time to go deep into it. So that's why I call for this extra class. So let me share already. Straight to the point. Share already.
Okay,
Can. Okay. The class rep also help me to monitor the attendance. Thank you. The recording button is rolling.
Yes.
Yes.
Haven't started. Okay. Okay, you should see my screen right now.
Yes, can see.
So later, you have any question, you can ask me. But let me go to cover all this first. All we have done already. Okay, now we move to the last concept on the time values of money. That is depreciation. And I explained to you why we need depreciation already, right? I believe that last week I did go tell you why we need depreciation and what are the terminology that we use. And normally when the asset is to be depreciated, it should cover to what stage, right? All these are already discussed. I hope you can still remember, but it's all logic, right? When you buy an asset that you're not able to use it, that means your asset is not to the workable stage yet. So the depreciation basically cover whatever expenses, including the cost plus expenses that require you to be able to put up the asset into the useful stage. So always remember that. Don't just buy, that's it. Okay, now we are going into the depreciation technique calculation already. All these are calculation. Of course, there is a formula, and the formula is straightforward, not difficult. The difficult part is how to choose. Is always a few techniques that come to us, and which is the technique that it is actually good to use. You just hold on for a while. All right, so we have to go through all because all are useful. When we say techniques, we say a few, basically they are useful. They are used for different circumstances. So sometimes we have to match it to the right situation, then it becomes something that's valid, right? Okay, so let's look at how to calculate, and this will be the techniques that we're going to learn. So we need to select once the cost and the service line, right? You need all the cost and the service line. That means it will be used for a period of time. So this period of time is actually considered your service life. Determine now, we say that we cannot recover it or we cannot put it as the expenses to deduct from your revenue in year one. Accounting what we call technique does not allow it. It said you should be recovered as an expenses from all the revenues that you generated throughout the life. That is the accounting law. Okay, so therefore we need to choose a technique that it is allow us to calculate what is the depreciation values from year to years until the end year. So it is a pattern, right? So we actually look at the pattern and over the life. There are many techniques. So one is the straight line. Straight line is the most simplest one. There is always one simplest. So sometimes you say simplest, no use, not necessary. I'll tell you when we use this simplest one. Then we move on to the more complicated one that is called accelerated. So this is straight line, so linear. When you use this word straight line for us, we know that it is a linear already. Accelerated means increase. Accelerated means you move it faster. So move it faster means what? Later we see. And under this technique, we are going to cover declining balance and then sum of the year digit and MACRS. That stands for Modified Accelerated Cost Recovery System. And also we have a technique that we call by units of production. Basically, it is referring to by usage. The more you use, the more you can depreciate it. So it is by usage. And it relates to our production. So straight line. So let's look at the first technique that's called straight line depreciation. It is simplest, and the formula is like that. Remember this formula. It is straight line. So you have a constant amount. Basically, we'll give you the constant amount, and this constant amount is per annum. If you use per annum, it's per annum. And normally per annum, if you prepare by year with regard to your asset, then it is per annum. So every year, the amount that you depreciate to your asset is the same. Depreciation, you always think that it is an expenses. Expenses, like you would buy raw material is expenses, you pay salary to the worker is expenses. So one of the type of expenses is called depreciation. Okay, so what is the amount? Basically, if you use this straight line, it will give you a constant amount, same every year, the same. And the calculation formula is cost minus the residual value. So this is your what? What is this term? Depreciation base. If you can still remember the terminology, this term is called depreciation base. So sometimes we say depreciation base over the useful life. Okay, so look at a very simple example here. A company buys a machine at a cost of 5K and has a salvage value of 1K. Useful life is 5 years. So your depreciation base is 5K minus 1K divided by 5. So every year you have 500. So one of the expenses that you are going to put up in your cash flow of this project is expenses. Depreciation is 800, 800, 800, 800, 800, right? So this is called straight line depreciation. Okay, another example. Assume that a company purchased a new equipment and the following information is available, right? Okay, so you got every year is 20. This one, I put it up for you to see the ending book value. Still remember the ending book value that we explained? We says that this is a book value. It is talking about at that particular point of time before the last usage or before the last year of your asset, what is the amount of values of an asset? Because we know that at the end of the life, your values of asset must be equal to your salvage value, right? So this is terminating values. However, along the usage of the life that time, you sometimes need to know what is the book value. What is the book value? So this example actually showing how to compute the book value. So book value is year by year because you have to see at that particular point of time. So when we prepare accounting documents, normally it's at the end of the year, right? So we prepare year by year. So let's look at this. What is the ending book value? So when you're doing the ending book value, of course, you have the beginning book value and then minus of your expenses or your depreciation as an expenses, then only you do the value. So sometimes you don't need this, it's okay. This is talking about what is the cumulative depreciation that you accumulate. And this two accumulate to this two accumulate to this accumulate to this accumulate to this kind of thing. But sometimes we do not need this because we are able to find what is the ending book value. So you start with 120K. And you see, when you buy that time, your accounting book value of this machine is 120K. Like over 1 year, you will be depreciated by the amount of 20K, right? So ending book value at year 1. So this is beginning, this is ending. That you will get 100K. So 100K will become your next year beginning book value, right? When you prepare the next year's bookkeeping or the accounting that time, your book value at that particular point, it will be 100K. Then minus another 20 because it's straight line, same amount. It will be 800 and minus another 20, 60, minus another 20, 40, minus another 20. So can you see? your ending or your terminating values of your asset is your salvage value. Clear? Okay, because that is the salvage value that you actually anticipated to have when the machine is end of life. Clear? Okay, so let's look at any more simple. Okay. This one, another one. Later I'll link it to when you use it. Always need to tell you when you use it. Another example first. Consider a piece of equipment that costs 25K with an estimated of 8 years, zero salvage value. So this machine, no salvage values at all. So the depreciation will be like that. So go back to the example. So again, this is same, right? So you see at the end also you come to zero. So every year the same. So it's a straight line. So you can see that it's a straight line. Means the rate, when it says the straight line, is the rate of depreciation is the same. It's constant. So we say constant. Constancy. So that's why we say it is linear, right? Okay, so let's so when will be simple? When do we use this? It's simple. It also is used. Don't always pick complicated. Not necessarily complicated one will be suitable. Sometimes we just able to use a simple one. So simple, normally we use it for simple project, right? So simple project is basically duration is short. When the duration is short, you don't have to go and complicate yourself by looking into MSCRS, 100% declining, all those kind of things. It's not necessary because the duration is short. The other condition could be the amount is low also. I mean, it's a small amount of money. So it don't really that significant when you use a more complicated kind of method. Clear? Okay, so duration short and amount is small. This kind of project we call simple project. That is one area of usage that you can use. The other area of usage that you can use is sometimes in our hand we have a few projects and then we need to evaluate it. At the beginning we have a few days, but we want to do short listing. We don't want, we say you need to short list out of this 5, maybe short list 2 first. So when you are doing a short listing kind of project, you don't need to use a comprehensive one first. So you can actually subject this into a simple one and select those you have give you a good result first. Then the one that not you can actually eliminate. So it is good for elimination. You get what I mean? It's good for elimination because there's too many. Everything you go into comprehensive, you will take a lot of time, and you may end up with losing the project. So in that sense, we can also do a quick check by using the simple technique. Clear? Okay, so I link it up to the usage so that you are able to know, okay, simple, but it is useful at that stage or at that moment of time. Okay, then we go on to double declining balance method. The word here is double declining. Actually, it is called declining balance method. If you see my earlier slide, right? I call it a declining balance depreciation. So under this category, if you are going to read it from the book again, there are many in it. We have double declining, 150%, 250%, all methods inside. But I just want to introduce you with this method called double declining. So it is a specific technique in declining balance method, double declining. Okay. So each of them have a different formula actually. So you have to look at the formula, but it works the same way. So it is an accelerated. I put them under the accelerated depreciation method. So what is the meaning of accelerated here? Accelerated means acceleration. That means you don't want it to go straight, but you want to make it faster. Make it faster. Faster at the beginning of the life, that time, so you depreciate more. In other words, you want it to be depreciate more at the beginning period of the life and then slowly go down. Clear? Okay, so that is the meaning of accelerated, right? So why it is useful? level, we discuss first. We go into the technique first, and then we come back to understand why we need to use accelerator and what is the advantage they give it to us when this technique is applied to our asset in our financial analysis. So the annual depreciation date is double. So the word here double means it double the straight line. That means whatever straight line has, it double up the straight line, 2 times the straight line. So therefore it's called double declining balanced method. So you go back to the straight line rate. What is the straight line rate? What is the straight line rate? Basically the straight line rate is this one. This is your rate. 1 over n is your rate. Then you multiply by your, what we call your depreciation base. So this is your rate, right? If it is 5 years, what is your rate of decline? What is your rate of depreciation? 1 over 5. It is 2 years, 1 over 2. If it is 8 years, 1 over 8. So 1 over n is the rate for straight line depreciation. So in this case, when you say 2 double up the straight line rate, basically it is 2 times. So I give you the straight line rate over here. So when you use it that time, basically you multiply by 2. So you need to find what is your straight line rate first, and then multiply by 2. That will give you the rate in percentage. In percentage. Rate is in percentage. So let's look at this, and we also work out the ending book value here together. So original cost, in that sense, if you look at double declining, you won't get a fixed constant amount of depreciation. So you are required to calculate what is your depreciation, and it changes from year to year, changing from year to year. So let's work on this example. The original cost is 120K, useful life is 5 years, salvage value is 20K. So how we work out by using this double declining balance. So let's do it. It has to be year by year. So 120K is your beginning book value, your cost. Definitely this will be your beginning book value. And we have calculated that every year there will be a 40% kind of depreciation, right? So you times 40%. Times the 40%, you times this and this, you get 48K, right? So this is the amount that is allowed to be depreciated on in year 1. So 120K minus 48, it is 72K. So it is using rate for calculation. Using rate, yeah. So this, when you post it to your next year, will be 72K. Again, multiply by 40%, you get this amount. So this minus this will give you this. So your beginning book value minus your expenses will give you the ending book value. So when we move on to year 3, your year 2 ending book value will be your beginning, and with another 40% of depreciation, it will be equal to 7280. So your 43200 minus 17280 will give you 25920. Okay, so you post it again into the following year, and look out for here. When you multiply by 40% of it, it is 10,368. You just check, it is 10,000. But what is your salvage value? I tell you that salvage value is supposed to be the terminating values when the project it is at the end of the life. So it should be 20,000 here. You cannot change your ending. You cannot change your salvage value. So you have to get this value. See, at the end of year 5, you have to get your values of the asset at this 20K. So in that sense, if you use 25,920 minus 10,368, you got an ending book value of negative. There is no such thing as ending net book value of negative. So instead of using the full 40%, what you can do is you have to find this value when this minus this will give you 20,000. Because it's already below 20,000 and you need to keep it at 20,000. You keep it at 20,000. So in that sense, you have to use this minus 20,000, then only you are able to find what is the amount that it is allowed for depreciation in year 4. Clear? So you cannot use this, you have to use this. So when you move on to the 5th year, You move on to the phase year, definitely what you need to do, you have to use 0. You have to use 0 because it's already touching your ending book value. So this will be your depreciation value. Clear? Clear? Okay. So that's how it shows. How it shows that when you are accelerated, before you reach the end, you already depreciate fully already. Clear? Because you accelerate it, instead of 20% initially, now every year going up to 40%. So definitely before the end, you already fully depreciated. So in this one, it's actually fully depreciated at 3 year plus, not even 4 years. It's already touching your 20,000. Yeah. So that is double declining. Okay, one more example. On April 1, 2010, this is the with date already. A company X purchased an equipment for 100K. This is expected to have 5 years, and the salvage value is 14K. Company X considers depreciation expenses nearest whole month. This is a special condition put in. Calculate the depreciation expenses for 2012, 2013, 14, 15, 16 using a double declining balanced method. So useful is 5. Straight line is 1/5. So therefore, you get 40%. So this is clear already. So we got to do one by one. We got to do now 2012. 2012, your machine is buying at this cost, right? So 100K times 40%. This is the rate. Take note on this. When you are in 2012, the machine will not be used for full year, right? So this is yearly. Can you see the 40% is yearly? So therefore, when it is not a full year, that's why you put a sentence here. So sometimes when we do not put, you also have to understand. Okay, considers depreciation to the nearest whole month. So we are actually taking month as your basis. So in that sense, you have to multiply by 9/12 because when you calculate April to December, it is 9 months. It is 9 months inside. So 9 of these 12. You use 9 months out of the 12 months. Now multiply by this. This will be your depreciation for the first year, not fully 40%. So when you go on to 2013, of course, then you have to minus this, right? So this is the allowed depreciation for 2012. So you minus this, and then you can multiply 40% full already. Full already. So you times 1. So you don't have to consider it's fully year. So it becomes like that. And then the third year, it will be like that by that, and goes on and goes on already lah. So going on, and then you get the result over here. Okay, so this is your result here, 140%. So depreciation is 30K. It is not a full, but it is a 30K here. So it's still here you get this, and then there is a full. This one is full already, full already, full already. There is no, this one is no, is there a salvage value? Is there a salvage given? Salvage
Yes.
value given, yes, 14K. So somehow you have to keep it at 14K. So you can see that this figure must be adjusted. As long as it is above 15K, it is okay. Then you adjusted it, right? So in the 2016, it is adjusted so that you will be able to get your salvage value at 14K at the end of the line. Okay, so it is a 5 years line. 1, 2, 3, 4, 5. Actually, 2015. Okay. All right. Okay. Then before we move on to the next technique, let's look at when you use this. Why we use double declining? They are in the accelerated category, or will serve the same purpose. You want to make faster, depreciate faster. When you say you depreciate faster, what is the meaning? You recover your cost faster. You get what I mean? Correct, because you are taking out as your expenses. So let's say you don't, this is 5 years, but before 5 years, you already take back your cost. So that is what we mean by accelerated. You actually apply a technique to recover your cost faster. And of course, when we look at business, the faster you get back your cost from your revenues, the better, because the more you go into the future, there are more uncertainty. First of all, there are more uncertainty. Second thing, if this is a machine, maybe you say 5 years, but after 3 years, 4 years, there's new technology already. Your machine may be obsoleted, and you want to consider to replace with another machine. And if you don't depreciate it faster, your machine still have useful, we have book values of, clear? So sometimes the more advanced technology kind of machine, it is better for you to recover your cost faster, to reduce your risk, in other words, the risk, okay? So that is the reason why accelerated depreciation method is introduced into this calculation. And of course, first thing is you want it faster, and this kind of is very useful when you have a long period of project, 8 years, 10 years, 15 years, you better recover earlier. The more you say 15 years, it means not last until 15 years, your project is already dying off. For example, your product, you expect it to sell 15 years in the market, but maybe 10 years, 20, 12 years that time, you already dies off already. So therefore, this will allow your project to recover faster. Okay, so that is the usage of double declining. And take note, double declining ends before life. Ends before life. This example has shown. This example also shown end before life. This one ends before life because they started in April. So when you're talking about life, it should go into 2017. And you're talking about the life because April month, so you have to go into 2017. You have some residues here, but it's already end. So that is to show that it ends earlier than the life. Yeah. Okay, now we are moving on to another type of accelerated. So accelerated, I put in a few for you all to see because sometimes our projects are long, so we don't actually rely on simple. We have to move on to look at this kind of techniques. Sum of the year digit, in short, it is called SYD. It is a form, it is again, but the accelerated rate is different. How fast only? So when you say accelerated, then you say, okay, how your gradient move, right? Is it like that, is it like that, is it like mild, right? So that there are different ways to accelerate it, no? So this will have a different way to accelerate it. So that is what you mean here. Resulted in greater depreciation in the earlier year and less in the later year. This one we know already. Now we look at the calculation. So this is the calculation. Assume that a plant asset is purchased for a cost of 160K. The asset has a useful life of 5 years and then sold for 10K. So this is your scrap. Read the question. Basically, this will give you the scrap. So sum of the year require you to calculate what is your SYD first. So it's a digit. So we call it a digit, right? A digit comes from where? Sum of the years. So what is your years? Years is looking at your useful life. Your N is equal to 5, right? So this is your years that we are talking about. So look at your useful life. So sum of the digit meaning that you add up the years of your useful life. That means you have 1, 2, 3, 4, 5, right? So what you do is just add it up. Simple calculation. You will get that it is 15 for a 5 year. It is 6 years, then you add a 6 again. So first year, it is, when you say first year, what is the rate that you use? You go this way. First year, you use this digit. Second year, you use this digit. Third year, fourth year, 5 year. So you see from more to less. That is what we mean by accelerated for sum of the year digit. So first year, we use this rate that is 5/15 for first year, 4/15, 3/15, 2/15, 1/15. So that is the technique, standard one. So in first year, what you do is you use 5/15, multiply by what? Take note here. Multiply by the depreciation base. It is not multiplied by the cost. Rate you multiply by the depreciation base because you have to use 160 minus 10K. This is the standard formula. Clear? Okay, yeah. So therefore you get the 50K. So same thing when you go into the second year, you actually have this, right? 150. So second year you use 4/15 same. Also multiply by the depreciation base. 5/15 times 4/15 times 3/15 times 2/15 times. Can you see they are the same because this rate is multiplied by the depreciation base, and then you get this. Then only you minus off from your asset values that is initially at 160 minus this, you get this. Push it to the second year, this minus this, you get this. This minus this, you get this. This minus this, you get this. Moving on, this minus this, you get this. Okay, for some of the year, it will end with the salvage value, when you are actually looking at full life. Full life means that you don't adjust it to the partial life. Let's say this is full life 1, 2, 3, 4, 5. When you finish at the 5th year, you will sure end with your scrap value. Okay, that means how long it takes to depreciate. It is also the n years. That means you won't make it faster, but what it make it faster is the amount. But when talking about the year it takes to fully depreciate is also n. But the amount is more at the beginning, less at the later. Unlike this double declining, before end of the life is already fully depreciated. So if I asked you which one is having a acceleration rate that is faster, definitely double declining has compared to some of the year. When you see now the difference in the accelerated, how fast it depreciate. All right, okay, now we move on. Until now, any question that you want to ask me?
No.
That is good. Okay, moving on. Now we look at this, the next technique. I put in 3, right? I put in 3 in your accelerated. So this will be your last one. So there are more, just that there are more that, but I'll just pick up a few for entry level because we are all in the entry level. So at least you must know all these are the common one in use first. Then upon use already, then you can research more on your own already. The next one is called Modified Accelerated Cost Recovery System, MACRS technique. And this is in short, so we can just call it MACRS. And it uses this word. It's actually do away with depreciation. We say it's recovery. Okay, so slightly different. I'll tell you what is the slightly different. But when we calculate that time, the technique is the same. MACRS allows for greater acceleration depreciation over longer time periods. This is very good when you have a very long project and you can actually choose to set what is the years that you want to take the project to be depreciated. You have to make a decision first before you apply this technique, that how many years you want to recover your asset. That is the reason they put this word recovery. It is not, but example, as some of the year we still have to calculate what is the SYD, double declining, we still have to calculate the percentage of the N, right? So this one you decide how long you want to take to depreciate your asset. So that is the reason recovery is used. Faster acceleration allows individuals to deduct greater amounts during the first year of the asset, right? So I tell this is the reason that we want to use, and of course the risk will be less if you are able to do earlier recovery. It is based, MACRS is based on recovery period instead of useful period. So they don't look at the useful period. That one we always look at N, right? You must know the N, then only you calculate SYD. You must know the N, then you are able to calculate what is the double declining rate. So these MACRS, they do away with useful life. They say you fix a recovery period, how many years you actually wanted to decide that your asset to be released. So they give you a free hand in that sense to decide. So these periods were predetermined. Decide first. Predetermined here, you must decide. However, of course, when you use it, how we decide is another issue, right? So we have these manual, kind of manual or guidelines that already classify assets into different categories and already suggested. So over the years, they already kind of decide if you buy this kind of asset for this kind of use, you classify it. So we can actually always refer to the what we call the manual, sometimes I call it the guideline, that give us an indication of what should be the recovery period can be used for the asset that you want to depreciate. Okay, so it's not blindly, don't blindly fix. We always refer to something that can justify our calculation. Then only you're able to explain to your, let's say your project manager, then you're able to explain to your boss when boss put out all this kind of question, right? So you have basis. There's always a basis. We are not sure, but we base on this. If the basis wrong, we change the basis. But if you don't have a basis, then you are doing blind. So take note on this. So I asked a lot of basis. What is the basis? Why you say the salary of workers like that? What is the basis kind of thing? So always look for basis. Because when you put out your basis wrong, we just change the basis. Then it's still valid. But you know basis very, very dangerous. So this table provides the percentage of the asset cost that can be taken. So once you decide already, then you can refer to a table. We call it MACRS depreciation schedule. That table is called this thing. MACRS depreciation schedule. So it is how it works. Basically, it is a mathematical modeling already built into this schedule. You don't have to know what is the formula or the mathematical equation that they use to come up with this percentage, but the underlying factor is they use a declining balance method, not double declining. Under it, there is a declining balance method. Then you switch it to a straight line. So they combine this one. And this declining balance has not double. You have 100%, 150, 200. Just now you heard me saying that when double decline, when there's declining balance, the 100%, 150, 200. That is what you see over here. They actually use declining balance of this percentage at the beginning, then switch it to straight line towards the later part. All right. So in that sense, they have many schedules. If you have this, you have one schedule. You have this, you have one schedule. You have this, you have one schedule. So MACR depreciation schedule has actually a few tables, not one. So we are going to use that table and then calculate the depreciation. Another note to take here. Even though you have the asset with the scrap value, but when you apply this technique, we always assume scrap value is 0. Apply that time only, but later on this scrap value will appear somewhere in your project. But when you calculate your depreciation that time, you don't take consideration of your scrap value. You always assume it to be 0. Okay, so the MACRS method must also be adjusted for partial year of service. Okay, so this is when you buy the asset. So we have this tax advantage, right? They tell you that how you schedule your asset buying because it was going to affect your tax kind of consideration, right? So same thing, you need to adjust it to when you purchase it, right? So you will see half year table, mid-quarter year table, mid-month quarter year table. This one, just know because you all don't have no, we do not go into deep this deep yet by knowing when you use half yearly, when you use mid-quarterly, right? So I'm going to provide you with a standard one that it is most commonly that we use one, and then we adhere to that one and use first. So later on, when you want to explore more, then we go into this. All right, we start with one that is commonly used on first. So this convention are built into tables in which IRS provides for computing. So you can use it for to compute your depreciation. The percentage given in the table are based on the original cost of the assets. So you don't use depreciation base. Against it, you only use the original cost. So we have this classification. Example, you look at 3 years property, they call asset as property. In that guideline, you will see that property is not a housing, because it is also another word that we refer to asset. Asset is also your property. So you see tractors, unit, cars, taxi, all these are under this category. Office furniture is the category. So it's just some example for you to show that they actually give some suggestion as how to pick up what is the number of years for recovery, right? 3 years means 3-year recovery, 5 years, 7 years. Okay, so this is a MSL. So I give you example over here. So you go and read it. And this is the table. It's not clear, it's okay. So later we're going to use a clearer one. So we have 3 years, 3 years, 5 years, 7 years, kind of things. I also cannot see properly. 3 years, different tables. So I'm going to show it to you. There are different tables. General. Okay, so use this one as your basis first. This is the general depreciation table. So we're 3 years, 5 years, 7 years, 10 years, 15, 20 years. So you can have long one. So 3 years we have 4 years, 5 years we have 6 years, 10 years we have 11 years, 15 we have 16, 20 we have 21. That's why you don't have 4. That's why you don't have 6. That's why you don't have 8. Right? Why? Why 3 years we got 4 values? When you add up this must be 100. This must be 100 because must be 100% depreciated. The salvage value is considered 0, right? So once everything is added, it must be fully depreciated. That's why all this percentage, when you calculate until the end, that time is 100%. 100%. So in that sense, you don't look at the end. You don't look at the end. You just pick whether you want to choose this or this. But take note on this. When you choose your class, or we call this class, 5 years class, 7 years, we choose your class that time. Make sure that it has to be shorter than your end. Yeah, example, this is your end is 10 years. You don't go and choose 15 years. Yeah. We want it to be accelerated already. Because we choose 15 years, you will end only 16 years later. It's not logic, right? It's not logic. So even though we say we don't use the end, but end is a reference to us. It is a reference to us. We know we can use it for 10 years. Maybe we choose the 7 years one. Because 10 years also not good. What? Because 11, it goes into 11 years. By the time 10 years, you have some residue go into the 11 year. So maybe we choose a 7-year one. Or you want to really too fast, you go to 5 years. You get me? So don't choose a one that is more than your salvage, more than your useful life. That doesn't serve your purpose at all already. All right. So you need to choose the one that suitable to your useful life. Then you apply the percentage. Whatever given here is your percentage already. First year, you depreciate by 33.33%. Second year, 44.45%. Third year, 14.81%. And fourth year, 7.41%. That's why I asked you a question that why 3 years got 4 years? 3 years class got 4. Depreciated over 4 years. This is your class, but your depreciation is in 4 years. Think. Later we come back. We discuss. Okay, then we look at the technique first. Okay, a front-end loader cost will decay and has a depreciable salvage value of 10K at the end of 5 years useful life. Computing the depreciation schedule on book value tractor using depreciation. This year, exactly 5 years. This one he used class 5. class 5 got, if you look at class 5, basically it is 20, 32, 19.2, this one. So you look at that, this is the percentage of 20, 32, 19.2, 11.54, okay. So what is the first year? In that first year, is it based on cost? Everything based on cost. So simple, you just multiply by your cost. You get this. So this will be your ending book value. So this column will be ending book. Okay. So based on cost, everything based on cost. So minus this, you get this. This based on cost. This based on cost. This based on cost. This based on cost. Okay. Clear?
Yeah.
Okay.
Yes.
This is the technique. Okay, we move on to the last technique that is called by units of production technique. And this is the only technique that allows us to charge by usage. Charge your depreciation expenses by usage, meaning that the more you use, the higher the amount that you can depreciate, especially for asset that it's can be output can be counted one. Output can be counted one. So use for asset that is not in continuous. Example, your machine. Your machine, you can say that my machine used for one shift, my machine used for two shifts, my machine for three shifts. Can you see? When your asset is not in continuous use, it is useful that the asset value is more closely related to the number. That's what I mean, output. If your output can be counted, then we can actually use this rather than looking at the year. So sometimes when we buy equipment from supplier, some supplier, they don't guarantee by year. It's a warranty 5 years. This 5 years may not make sense to the machine supplier because this 5 years you can use 24 hours per day, 7 days a week, 350 days in a year, as compared to another one, what we call factory that use for one shift only. So sometimes machine warranty they do by count, but how many shots, they tell you how many shots I'm going to guarantee you. Shots means how is the production cycle that you can use it. So that is things that you will see the one. I cannot warranty you by years. I can only warranty you by the shots that you produce. In that sense, basically, it is referring to this technique, because usage does matters into the asset values. So it results in greater deduction in years when your asset is heavily used. When the asset is not used, you actually cannot be depreciated. Okay, so higher charge is when it's higher activity, less charge is lower activity. So you look at this word activity. Later I'm going to link it to you to the cost that you have, the behavior. When we look at cost behavior, we look at the activity, right? Okay. So later on, I'm going to link up to this one. Zero depreciation is charged when the asset is idle. Idle means it's not used at all, right? So in such, let's pick up this formula here. This formula that you need to pick it up and apply it. So depreciation is per unit, because it's based on the output. So in that sense, when you calculate your depreciation, basically you have to calculate this first. What is the depreciation per unit? The amount per unit, and it is given by this formula. So it is number of unit that you produce per unit first, then you multiply by this. This is per unit. Okay, this side is per unit. So when you multiply by the number of units produced in that particular year, then you get your depreciation amount. So first calculate what is your depreciation per unit. It will give you a constant amount. Okay, it is a cost minus a salvage value. This is your base for depreciation over the warranty life. The life is not warranty by year. The life is warranty by units. I already explained to you, right? Okay, so now your life is look at the units that you produce, not the year that you use. You can use the machine. Clear? So in that sense, you got your cost per unit, and then you multiply by whatever unit that you produce within that period of time. So that will give you your depreciation expenses. So example, a plant costing 110 million was purchased on April 1, 2010. The salvage value was estimated to be 10 million. The expected production was 150 units. So this plant is expected to generate or to produce 150 units. The plant was used to produce 15 million till the end of December 31. Calculate the depreciation on the plant for the year ended this month. Okay, so look at here. Basically, what is your depreciation per unit? You're using this as your depreciation base, right? Your 110 is your costing minus your salvage value over your 150, that is your expected volume. Then multiply it by 2011. You have 2011 April that time until December 15. So that is the year. So you don't have to adjust. You see, this one you don't have to adjust. Even though it is April 1st, you start to use and we want to calculate into the December, do we do adjustment? No, because it is talking about how much you produce. The more you produce, the more, that's it. So no adjustment is needed. Clear? Clear? Okay, so we look at the quantity rather than the period. So in that sense, your solution is your depreciation for the year 2011 is 10 million. A coal mine was purchased by X Corporation for 16 million. It was estimated that the mine has a capacity to produce tons of coal. The company extracted 46 tons during the first year of operation. Calculate the depreciation. Same thing. You have the 16 million, no salvage value. If not mentioned, you can always put the assumption there. Don't say no salvage value cannot do. Just put that, ignore or neglect neglect ignore neglect salvage value . Okay, so in that sense, this is your full cost. You don't have to minus that one over your capacity. This is your capacity, right? And then multiply by the usage in that year. So that will be your salvage value. The effect of it. I'm going to show the three very fast. Okay, I'm going to show the effect. So let you all see the effect of it. So effect, straight line, of course, the same. Every year the same, right? So there's no constant effect. Don't say no effect. It is like that. It is straight line pattern. Accelerated is more than less, right? So you will see that it's like that. So that is what you see, the pattern of accelerated. Okay, so impact. Okay, now I'm going to show it to you. Put up everything into this graph and you see the total amount of depreciated charge over an asset entire run is same irrespective of the choice of the depreciation method, right? The amount, the total amount is the same, right? So at the end, you must recover. What I mean here is at the end, you must recover. So the total amount of this depreciation that you calculate is the same, no matter or which technique that you use. The adoption of the particular depreciation method does, however, affect the amount of the depreciation expenses in each year. So what is the difference is total is the same, but it does affect what is the amount charged in each year of the asset's life. Clear? Yeah. So see this one. See this one. We have straight line, we have double declining. We have by units, we have sum of the year. Let's see how it works. Straight line, this one, definitely, this is your straight line, right? Every year the same. Okay, and here, right? Okay, so this one, I want to rule out this one first. This one fluctuate because you don't know. It's actually fluctuating. The more you use, the more you depreciate, right? So it is a kind of random graph. Really random because we cannot see usage pattern unless that is depending on your usage pattern. So that is by unit. So this one is by unit. Okay, I want you to compare these two because they are in the same category. SYD and DDB is in the same category. So I want you to see the rate of the accelerated. And in fact, just now I briefly already explained to you already. So if you look at the SYD, it is this way accelerate because It has a fixed pattern to accelerate. But when you look at double declining, it is this way. So you have more. You have more to depreciate at the early, and then at the end you reach up the same. Okay, clear? Okay, so that is for you to take a look at the impact, because sometimes when we choose the technique, we want to evaluate what is the impact, and this kind of question normally I will ask. When you change the technique, I ask you to evaluate first using this technique, and the second part I ask you what is the impact if the depreciation technique is moved or is changed to this technique instead of the earlier one that you used. So a lot of time when we choose that time, we are actually looking into the impact or the effect of it for us to see the results. So in project analysis also the same. So sometimes we start with this one, and we like to look at if we change the depreciation technique, how it affect our cash flow. And then you may get a better result in that sense. Okay, so, okay, so this is the here. Let's see this one. Also same thing. One is by unit, random one. So at the end, total year finish, you also finish everything. But why MACRS not here? Because MACRS is very, very, oh, it's time already, right?
Yeah.
I have to stop because Dr. Seuss class.
Yeah.
Am I right? Okay. I will stop. Okay, and I want to do, can you just tell me? I will, attendance, tell me. I will